Markets at an all-time high. The ring of it all, makes you feel happy. But the problem is that even though you're at an all-time high, economic indicators are at an all-time low. Unemployment rate, GDP growth, corporate profitability, top line, what companies have reported for the quarter gone by. So who's going to get it right? Who's going to get it wrong? Do you think the bulls who are believing that tomorrow is going to be better than today, will they get it wrong? Or somewhere those who are getting overexcited about these levels, they will get it wrong?
Good morning, Nikunj. You are very right. If you look at economy, it's at a low. If you look at large cap indices, they are at a high. That seems to be a disconnect. But if you look deeper, I don't think there is a disconnect between economy and the markets. Why do I say that? If you look at NSE mid cap index, for example, it's almost 20 to 25% below its peak. And if you look at NSE small cap index, it's almost 40% below its peak. So I think the broader market is exhibiting the same kind of stress that the economy is currently witnessing. There is no disconnect at all. But what we are noticing is while the economic growth numbers are still subdued, the valuation is giving comfort to a lot of select mid and small caps. And that's where in the last 3 months, for example, a lot of investor interest has got built up. And we are also seeing slowly the market breadth improving. So overall, we believe that while the markets may remain choppy, there is money to be made in the broader markets, especially in the mid and smaller segment. It's no more about getting polarized in terms of few stocks. If you are a stock picker, if you are finding good value at a certain level, then one should be building that portfolio, and hopefully over the next recovery period, this is the basket that will give better wealth.
Easier said than done. Where you can see growth, there is no value. Where there is value, there is no growth. How do you solve this dichotomy? We can work with an assumption that economy will come back, but all those assumptions have not made money. We can work with an assumption that you will not make money if you buy Bajaj Finance or a DMart or a HUL at these levels, but those stocks are making money. So sensible investing is not working, and more like a follow the herd or a Rip Van Winkle effect is working.
Clearly, there are two buckets, as you mentioned. One is a bucket where the valuations are high and maybe there is some steadiness in terms of earnings growth. But there is that other bucket which is completely beaten down. It may look like very attractive, but obviously things are not great there. What we are doing currently, while we are not completely getting out of some of the names where there is steadiness in terms of growth, we are also looking for opportunities where valuations have more or less discounted all the negatives, and we are finding some opportunity in terms of growth recovery. That's where we are putting our money into. I think it's going to be a gradual process. As you said, I don't think there is one way or the other that you can choose right now. You have to keep gradually building your portfolio away from some of the expensive stocks, away from the pocket which has seen over ownership, and slowly get into the pocket where when the economic activity revives, there will be a better upside in terms of stock returns. That's where you need to go, but how much you will go progressively, that has to be calibrated based on the risk that you see in the market.
So one is wondering, while you've got a 13% recovery from the 52-week lows on the mid-cap index, tactically, do you reduce your exposure to large caps and nibble a little bit more selectively, albeit within mid-caps?
We have been doing that across our portfolios wherever the investment mandate allows. Let me share another statistic. If you look at the total mutual fund allocation to Nifty stocks, it's currently at about 64%. In the past, whenever this ratio has crossed 65%, there has been some sort of a shift that happens from mid-cap to large cap to mid-cap in terms of interest. In the past, this proportion has peaked out somewhere between 67 to 68%. If you believe that that will hold true, maybe there is some more time before you actually see the peak of the large cap indices outperforming mid and small cap. But at some point of time in the next few months, it looks like the mid and small caps will start to perform much better than the large cap. And that's where the money is going to be made.
But Harsha, within large caps, the other debate is, do you diversify? Are large caps now headed in for a broader participation? Strength moving out of those 10, 15 names? Or do you continue to buy more of the same, even if ICICI Bank is now hitting at an all-time high, or an HDFC Bank, you continue to add more of those names on dips?
No, clearly we are moving away from some of those over-owned stocks. Yes, in the immediate short term, the growth may be very steady, but the valuations more than discount some of that in our opinion. And also it will be very difficult for us to change the entire portfolio composition as soon as we see some recovery in the economic activity. We have to be ahead of the time. And that's where I think the calibrated approach in terms of moving out of some of these stocks has already started in our portfolios.
457 rupees for Varroc Industries. We are looking at some strength coming back in autos. Harsha, how real is the strength in autos?
Nikunj, we still continue to be circumspect about recovery in the auto segment. The valuations have moved up from the beaten down valuation to the current levels, which more than discounts the kind of recovery that is actually taking place. I think there has been some extrapolation of the festive demand to continue into the future. I don't think that's happening. Clearly, we see that within the subsegments of auto, only two-wheelers at this point of time give some valuation comfort, but rest of the market is unlikely to see the same kind of demand that we saw in the month of October, and also the valuations are high. So to that extent, we have been very selective in our exposure to auto industry.
We can't put it.
Right. Harsha, just wondering, any of these other beaten down spaces where you think that, there is an opportunity, auto ancillaries and autos like Nikunj just asked you about, but what about other pockets which have been underperforming so far, where you identify there is an opportunity to buy into right now?
We have increased a little bit of our exposure to metal segment. You would remember in our last interaction as well, we spoke about this particular sector where while the fundamentals are still kind of subdued, the valuation comfort is there. So selectively we have been building some position in metals space. Although there have been a lot of news flows up and down in terms of the trade war receding and vice versa. But I don't think market is hoping too much from that angle. I think we have seen some stability in some of the metal segments in terms of pricing. Demand has also been okay, subdued, but nothing really falling short of expectations. So to that extent, I think it's one of those areas where one can start to look building some exposure. Obviously not for the immediate short term, but I think over the next couple of years, this basket can give better returns.
Okay, just some other names which I just want to revisit. While Yes Bank, of course, is your star performer today, and RBL Bank as well joins in the fray. And Harsha, the other thought of, some of these beleaguered banks which have had their fair share of bad news, big overhangs, lot of issues, and have really sort of risen from the ashes. And I can say that about Yes Bank, and similar applies to RBL Bank, looking at the way the stock price has been moving off late. Do you sense opportunity within banks in some of these beaten down names as well?
I think we are fairly okay with our current positioning in the banking sector, where we have bet on a mix of retail focused as well as corporate focused private sector banks, and also a couple of non-lending businesses such as life insurance and general insurance. Overall, we believe that wherever the asset quality is still holding up, wherever there is adequate capital to grow, and if the management is focusing on the right segments to grow, I think there is money to be made. Yes, with economic slowdown, the credit growth has also come off. There is some pressure in terms of the growth for most of the banks. But having said that, it is still one of those pockets where there is at least growth. And if credit costs start to normalize, there is enough kicker that you will see in terms of stock performance as well from some of these banks. And other banks are growing reasonably okay on the retail side, where risks have not been as high as what you have seen in the other segments. So overall, I think we will stick to our current positioning on the financials, which is more like a neutral to slightly overweight position.
Harsha, what is in for large cap investors now? Nifty is at 12,000. Most of the stocks where you see visibility are not priced to perfection, but in this case, they are priced to imperfection right now. Will money be made in 2 years in large cap stocks?
I think money will be made in large caps too, but I think it will be more moderate than what you would see in diversified funds or in mid and small cap funds. And also, whenever there is next bout of volatility, I don't think large cap basket will be spared. I think there will be volatility even in the large cap basket. So to that extent, I think what they have seen in the last 2 years, where it was more like a one-way movement for large caps without much of risk, is unlikely to continue in our opinion.
What is the downside for this market? Where do you think, if earnings don't recover, let's say next 6 months, and there is a very strong possibility, Harsha, it may happen this way, because consumption is not going to pick up, investment cycle is broken down, nothing magical will happen in next 6 months. Then what happens to the market? I mean, will they get frustrated? Will stock prices start coming down, or markets will continue to hide under this veil of liquidity?
Nikunj, it's always difficult to predict liquidity flow and sentiments. Having said that, I think if earnings don't recover, even with some of the things that have happened in the economy in the last couple of months, then I think market will still consolidate at around current levels. Maybe the choppiness on the downside will increase, but I don't see too much of a movement for markets, because when you are talking about next 6 months, you will ideally be looking at financial year 21 or 22 earnings. 20 will be behind us at that point of time. So to that extent, I think the hope which has been leading the markets for all these years will continue to lead in terms of expected recovery. So I won't see much of a downside, especially given that the tax rate cut boost has improved sentiments, and also from a valuation perspective, there is some enhancement that has happened to the market. But overall, yes, the choppiness on the downside could increase if earnings don't recover.
Great to have you on the show with us. Thank you so much for taking the time out and